Imagine walking into your favorite electronics store. You spot the latest smartphone. The price? $500. You pull out your credit card. One quick swipe, approved. Just like that, the phone is yours. No cash leaves your wallet. No banknotes change hands. It feels almost like free money. You walk out smiling, convinced you've made a smart purchase. But hidden behind that single swipe, a financial clock has just started ticking. Days turn into weeks. Weeks become months. Life gets busy. The bill arrives. You don't pay the full amount. Instead, you choose the option that looks harmless. Minimum payment due. It sounds responsible. It sounds affordable. After all, you're still paying something, right? But what if that one decision quietly transforms a $500 purchase into $900? Or even more? What if the bank isn't hoping you pay quickly, but hoping you don't? Every year, banks earn billions of dollars from credit cards. Not because people keep spending, but because millions unknowingly fall into a system that was designed to be incredibly profitable. So how does a tiny plastic card become one of the biggest money-making machines on Earth? And why are banks so eager to put one in your wallet? Today, we're pulling back the curtain on the business of credit cards, because once you understand how they really work, you'll never look at that little piece of plastic the same way again. At first glance, credit cards look like an incredible deal. Banks offer cashback, free flights, reward points, airport lounge access, even generous sign-up bonuses worth hundreds of dollars. It almost feels like banks are paying you to spend money. But here's the question. If banks are handing out all these rewards, who's actually paying for them? The answer is simple. You are, just not always in the way you think. Banks aren't charities. They're businesses. And like every successful business, they invest money only when they expect a much bigger return. Think about it. Why would a bank spend millions on advertisements encouraging you to apply for a credit card? Why send pre-approved offers to your mailbox? Why promise free rewards before you've even spent a single dollar? Because every new credit card customer is a long-term investment. The more people use their cards, the more opportunities banks have to earn money. Not just through interest, but through merchant fees, annual fees, late payment charges, foreign transaction fees, cash advance fees, and other services that most people never notice. One credit card can generate income for a bank for years. Multiply that by millions of customers across the world, and you've created one of the most profitable businesses ever built. But here's where things become even more fascinating. Banks don't actually need you to miss every payment. They only need you to make one small decision. A decision that millions of people make every single month. And it all starts with something called the minimum payment. Let's go back to that $500 smartphone. You walk into the store, you tap your credit card, approved. In just 2 seconds, the store receives its money, you take home your new phone, and the bank quietly steps into the middle of the transaction. But here's what most people never realize. The bank just paid the store on your behalf. At that moment, you don't owe the store anymore. You owe the bank. In other words, the bank has temporarily loaned you $500. Now the countdown begins. Most credit cards come with something called a grace period, usually around 20 to 55 days. If you repay the entire balance before that period ends, the bank typically charges no interest on your purchase. Sounds like a bad deal for the bank? Not at all. Because banks know something that statistics have proven for decades. Millions of people don't pay their full balance every month. Instead, they pay only part of what they owe. And the moment that happens, interest begins to grow. Not once, not twice, but every single month until the debt is cleared. That $500 purchase no longer stays a $500 purchase. With each passing month, the amount you owe slowly becomes larger. And remember, this isn't happening to just one person. It's happening to millions of credit card holders around the world, every single day. That's when a simple loan transforms into a powerful stream of income for the bank. But the real secret isn't the interest rate itself. It's how the bank convinces you to keep the debt alive without making it feel dangerous. And that's where the minimum payment changes everything. Now imagine your credit card bill finally arrives. You spent $500, but instead of asking you to pay the entire amount, the bank gives you another option. Minimum payment due, $25. It feels like a relief. Instead of paying $500 today, you only have to pay $25. For someone who's short on cash, it seems like the perfect solution. You make the payment, close the app, and move on with your life. But behind the scenes, something far more important just happened. Because while you paid $25, the remaining balance didn't disappear. It stayed on your account. And now it starts collecting interest. Next month, another bill arrives. Again, the bank doesn't demand the full balance. Instead, it offers another small minimum payment. It feels manageable, almost harmless, so you pay the minimum. Again and again. Month after month, you're making payments. Yet somehow, the total debt barely seems to shrink. Why? Because a large portion of every payment isn't reducing what you borrowed. It's paying the interest that has been quietly building in the background. The longer the balance remains unpaid, the more interest is added. The longer it takes to escape the debt. That's why banks love minimum payments. They make debt feel affordable today, while quietly extending it for months or even years. A purchase that once cost $500 can eventually cost hundreds or even thousands more. Not because you kept buying things, but because time became the bank's greatest profit maker. And here's the fascinating part. Interest isn't even the biggest source of income behind every credit card swipe. There's another fee that gets charged every single time you use your card, even if you pay your bill in full. Let's be honest. Who doesn't love free rewards? Spend money, earn cashback, collect airline miles, get free hotel stays, exclusive discounts, VIP airport lounges. On the surface, it feels like banks are rewarding you simply for using their credit card. But ask yourself one simple question. Why would a billion-dollar bank give away free money? The answer is, they're not losing money. They're investing it. Every time you swipe your credit card, the store doesn't receive the full payment. A small percentage, called a merchant fee, is deducted before the money reaches the business. That fee is shared between the companies that process the payment and the bank that issued your card. So even if you pay your credit card bill in full and never pay a single dollar in interest, the bank has often already earned money from your purchase. Now combine those merchant fees with annual fees, late fees, cash advance fees, and the interest paid by customers who carry balances. Suddenly, those reward points don't look so generous anymore. In reality, they're a marketing tool, a carefully designed incentive that encourages you to swipe your card more often. Because every extra purchase creates another opportunity for the bank to earn revenue. That's why banks compete so aggressively with bigger welcome bonuses, higher cashback rates, and premium reward programs. They're not just competing for your next purchase. They're competing for something far more valuable: your long-term spending habits. The more your credit card becomes your first choice for every coffee, grocery trip, online order, and vacation, the more profitable you become. But here's the twist. None of this means credit cards are bad. In fact, if you understand the rules of the game, you can flip the advantage completely in your favor. After everything you've learned, you might be wondering, should you stop using credit cards altogether? Surprisingly, no. The truth is, credit cards aren't designed to be good or bad. They're simply financial tools. And like any tool, the outcome depends on how you use it. The bank's most profitable customers aren't the ones who never use their cards. They're the ones who carry debt month after month. So if you want to beat the system, the first rule is simple. Always pay your full balance on time. Not the minimum payment, not half the balance, the full amount. When you do that, you can often enjoy the convenience, purchase protection, and rewards of a credit card without paying interest. Next, never spend money just to earn reward points. A 5% cashback offer sounds exciting, until you realize you've spent hundreds of dollars on things you never needed. Remember? Saving 100% is always better than earning 2% back. Another smart habit is treating your credit card like a debit card. Before every purchase, ask yourself one question. Do I already have this money in my bank account? If the answer is no, don't swipe. And finally, never mistake your credit limit for your budget. Just because a bank is willing to lend you more money doesn't mean you can afford to spend it. Banks calculate how much they're willing to risk. Only you can decide how much debt is worth carrying. Because in the end, the people who benefit the most from credit cards aren't the ones chasing rewards. They're the ones who understand the rules and refuse to pay unnecessary interest. And once you learn those rules, the game changes completely. So, do credit cards make banks billions of dollars? Absolutely. But not because the cards themselves are magical. Banks earn billions because millions of people unknowingly make the same expensive mistakes. Carrying balances, paying only the minimum, ignoring how interest quietly grows over time. The truth is, a credit card isn't your enemy, and the bank isn't secretly trying to ruin your life. Banks are businesses. Their job is to make money. Your job is to understand how the system works, because knowledge changes everything. The moment you stop paying unnecessary interest, the moment you use rewards wisely instead of chasing them, the moment you treat your credit card like a financial tool instead of extra income, you stop becoming the product, and you start becoming the person who benefits from the system. The wealthiest people don't win because they avoid financial tools. They win because they understand them better than everyone else. And that's exactly why financial education is so powerful. Every smart decision you make today can save you hundreds or even thousands of dollars in the future. So the next time you pull a credit card out of your wallet, remember this. The bank has already built a business model around your next decision. The question is, will your next swipe make the bank richer, or will it make you smarter? If you learned something new today, hit the like button and subscribe to Budget&Grow, where we break down complex money topics into simple, visual stories that help you make better financial decisions. And tell us in the comments, what's one thing about credit cards that surprised you the most? Because the more we understand how money works, the better we can make it work for us. Thanks for watching, and I'll see you in the next Budget&Grow video.